Here are 5 mistakes that you should avoid when you start trading stocks. Let's get into the video. Hi everyone, my name is Zach and welcome back to Finance Bro. Before we get into the video, I'd like to ask you guys to please leave a comment of your favorite stock of the moment, why it's favorite stock of the moment, and also leave a like and subscribe as it really helps with the YouTube algorithm. And I don't want to waste your time, so let's get into the first mistake that you should avoid when you start trading stocks. And that first mistake is going to be only trading penny stocks. This is a huge thing that I have noticed across all of our social media channels. That includes YouTube, Instagram, TikTok, you name it. People love when we talk about these lower cap penny stocks. People love this because they believe that there is an unlimited upside and a very little downside, but I am here to dispel that myth today. There's actually a very significant risk when you are trading penny stocks because you are dealing with companies that have, $1 billion, $2 billion valuations, and a lot of the time these companies are held by a few hedge funds and then about half retail investors. So if just one hedge fund decides to sell off half their position, or all of their position for that matter, that could tank the stock 5 to 10%, even 15%, and then retail investors will start getting out. As you see, a lot of the times these lower cap stocks will go from like $4 all the way down to $2, all because one hedge fund or one big company sells their position, and then it scares all the retail investors, and then everyone decides to sell all of their position. So a way to combat this is going to be trading higher cap stocks. So now all the way up here we have Apple. That's going to be a $2 trillion market cap. Obviously you don't really want to day and swing trade Apple because it takes a lot of money to actually move that stock's price and your percentage. So say you have 100%, Apple's not going to move more than 1% in a day, so it's going to be really hard to actually trade that. Now, if we are dealing with something like AMC, which is about $30 billion, it's going to be a lot easier to get 5 to 10% because you need less money to actually start trading those stocks. These low market cap stocks are very volatile. So a way to combat this is to trade stocks that are between a $5 or $10 billion market cap and a $30 billion market cap, because there's going to be a little bit more stability, but you're still going to be able to get really good gains out of it if some big players get involved. And also lastly, if you are trading these high risk penny stocks, make sure it's not more than 5 to 10% of your account, and on the high end 20% of your account, because you don't want to be losing all of your money just because one hedge fund pulls out their money. The second mistake that you have to avoid when you start trading stocks is not diversifying your account. Now this is huge. When you're diversifying your account and say you have about $10,000 and you have 20 to 30 different stocks, you're basically hedging your bets. So maybe you have a good amount of Apple, but you also want to be trading some penny stocks so that you can get a little bit more movement in your account instead of it just going up 1% or up or 1% down in a day. Basically, you should never be going all in on a day or swing trade, and by the way, a swing trade is any trade between about 1 to 5 days, but you should never be going in on these day and swing trades with your whole account, because that is how you basically lose all of your money in the stock market. Even when you're trading these penny stocks or lower cap stocks, make sure that you have staples of your account with high conviction stocks, such as mine is Disney, Corsair, and Apple. Basically, make sure you're not trading with more than 40% of your portfolio. The other 60%, or even more in my opinion, should be invested in long-term high conviction plays. Those for me are going to be Corsair, Disney, Apple, Amazon, Alibaba, among others as well. You basically do this so that you have stability in your account while also having higher risk so that you can make better returns with your trading. The third mistake that you need to avoid like the plague when you start trading stocks is going to be stop confusing price with value. What I mean by this is that a $10 stock is not necessarily worth less than a $100 stock per se. A $10 stock and a $100 stock could actually have the same company valuation. To see which stock has a higher valuation, you're going to want to check market cap. If we come here to the computer, I can show you that Chipotle actually has a $1,400 stock price, and AMC has a $60 stock price. But if you come here and look at market cap, they are basically valued at about $40 billion, Chipotle is, and AMC is valued at about $30 billion, so only a $10 billion difference, yet Chipotle is worth $1,400 stock price, and AMC is worth $60. Now Chipotle has a $1,400 stock price because they have very little shares in circulation, while AMC has a lot more shares in circulation. So they are very closely valued, but if you just looked at the stock's price, you would think that Chipotle is worth a lot more than AMC. So stop confusing stock price with value because they are not the same. The fourth mistake that you should avoid when you start trading stock is being afraid of taking profit. A lot of people, when they start trading stocks, are afraid to take profit because they are afraid they are going to miss out on further gains when they actually do take profit. But if possible, at least take your initial investment out. If you have gotten a huge return, more than 100%, make sure that you take your initial investment out so that you don't end up actually losing any money and you can just actually play with house money. Or you could just sell half your shares and then continue to make further gains if the stock's price keeps going up after that. Don't be greedy. Stocks usually don't run for more than 2 or 3 days at a time, and they will usually have a correction after a big run up in price, so make sure that you're not being greedy over, a whole week. The fifth mistake that you should avoid when you start trading stocks is not putting any money away for taxes. Now I know this isn't the fun part of the video, but we have to talk about taxes because they could be a major thorn in your side if you don't take care of them right when you sell a stock. A safe number that you're going to want to set aside for the profit on your stocks to give the taxman at the end of the year is going to be 40%. Because the short-term capital gains is actually around 37% right now if you're in a high tax bracket. So just to be safe, make sure that you're setting aside about 40% of your profits so that you have enough money to give the taxman at the end of the year. Now the tax code could be changing soon because of the Biden administration, so make sure that you are keeping up with politics, or consider talking to a financial advisor to get more information on taxes so that you make sure that you're in good standing with the government. And that is going to be it for the 5 mistakes to avoid when you start trading stocks. If you guys want to start trading stocks, make sure you check out the first link in the description to get signed up with WeBull. If you guys want to join our private Discord where we talk about our favorite stocks and crypto, then make sure you click the second link in the description and get signed up with our private Discord. But that is going to be pretty much be it for today. Thank you guys all for watching. Make sure you check out the video on the end screen right now, and I will see you in the next video.